Morning or good afternoon, everyone, depending on what time zone you're in. Thank you for joining us on today's webinar. My name is Mindy Gare, and I am the Southeast Region Business Development Manager for the Intrust Group, and I will be your host for the first part of the webinar today. We also have Richard Thornton, who is Managing Partner from the American Note Capital, who is going to be co-hosting with me on the webinar today. So real quickly before we get started, you will notice in the bottom left corner of your screen there is a chat box. Everyone's placed on mute, but if you have any questions throughout the presentation, you can go ahead and start typing those questions into the chat box on the bottom left of your screen. Also, real quickly before we get started, I have a quick disclaimer. Intrust does not provide investment advice, tax advice, or legal advice. We do not recommend or endorse any investments or products. We're not financial advisors, attorneys, or CPAs. We provide the record keeping and custodial services for self-directed IRAs, and this webinar is for educational purposes only. We do encourage all clients to consult with their attorneys, CPAs, or financial advisors before entering into any type of investment. All right, so the agenda for today. During this webinar, we are going to cover some basics on the Intrust Group. We're going to talk about what a self-directed IRA is, some benefits of self-direction, what you can invest in with a self-directed IRA and what you cannot invest in. Then I'm going to turn it over to Richard to discuss peer-to-peer lending. At the end of the presentation, we're going to open it up for the live Q&A where you'll be able to submit your questions in the chat box on the lower left corner of the screen. As I mentioned earlier, you can also do that throughout the presentation. And then some of the information that I may go over may be somewhat repetitive, but just bear with me. All right, so a little bit about the Intrust Group. We provide the record keeping and custodial services for true self-directed retirement plans. A true self-directed retirement account is where you can actually invest in assets outside of the traditional market of stocks, bonds, mutual funds. And I'll go over what some of those types of assets are later in this presentation. The Intrust Group has been in business for 37 years, and we administer about 22,000 accounts that consist of about $3.3 billion in assets. We are known as educators in our industry, and one of the distinguishing facts about our company is that we offer a single point of contact business model. So what that means is when you open an account with Intrust, your point of contact would be your local business development manager and their assistant. Most of our staff here at Intrust hold CISP designations, and CISP stands for Certified IRA Service Professionals. We have a national continuing education class for realtors and CPAs. We sponsor an IRA Academy, and this is where we actually teach the course that trains other people in our industry to pass the CISP course. We hold national and local events and webinars, very similar to what you're listening to today. If you're interested in learning more about those, contact your local respective business development manager. All right, so what is a self-directed IRA? A true self-directed IRA gives you the freedom and flexibility to choose your own investments. Self-directed means just as it sounds. As the owner of the account, you have complete control over selecting and directing your retirement investments. So that means you make all of the decisions regarding your investments and how you manage your funds. So you may ask, what exactly does Intrust do then? Well, as I mentioned earlier, we provide the record keeping and custodial services so that your self-directed retirement investments stay within a tax-sheltered account. We do all of the reporting to the IRS. In order to invest in an alternative asset, you have to find a custodian who is willing to hold those assets. So your standard custodians like a Charles Schwab or a Merrill Lynch or a TD Ameritrade, they may tell you that they offer self-directed accounts, but you are still limited to only investing in stocks, bonds, mutual funds. If you want to invest in assets outside of stocks, bonds, mutual funds, you have to move your money to a company like Intrust in order to invest in those non-traditional assets. And we will go over what those non-traditional assets are that the IRS does allow inside of a self-directed account later in the presentation. Self-directed IRAs have been around since 1975, and they are regulated and governed by the rules in various sections of the Internal Revenue Code. All right, so what are some benefits of self-direction? Well, in a self-directed IRA, you are able to take control over your investments and invest in assets that you know and understand the types of risks and returns that are associated with that investment. You are also able to create more diversification within your retirement portfolio. You know the old saying, don't put all your eggs in one basket. Well, self-direction allows you to spread out those eggs into multiple baskets, meaning investing in a variety of assets. And then there could also be some tax savings using a self-directed IRA. Your contributions could be tax deductible, tax deferred, or tax free depending on the type of account that you have. All right, so the types of investments that the IRS allows inside of a self-directed IRA. So what you can invest in inside of a self-directed IRA is very broad. You can invest in things such as real estate, trust deeds and mortgage notes, commercial property, promissory notes, limited liability companies, precious metals that include gold, silver, platinum, and palladium bullion of certain purity. You can invest in tax lien certificates, joint ventures, limited partnerships, private placement, offshore real estate, and I can go on, but we probably don't have enough time for me to list out everything that you can actually invest in. There are some restrictions on what you can invest in. So while the spectrum is very broad, the IRS does have 3 things that you are not allowed to invest in. The first being life insurance. That is not allowed inside of a self-directed IRA. You also are not allowed to invest in collectibles, and that can include things such as artwork, rugs, antiques, stamp collection, baseball card collection, alcohol collection, etc. Anything that would be considered a collectible. Now, for example, an alcohol collection is not an allowed investment. However, you could actually invest your money in, let's say, a winery or a brewery. Those would actually be considered allowed investments because you are now investing into a company and not a collectible item. And the last item that you're not allowed to invest in inside of a self-directed IRA is S corporations. Now, the IRS actually does not, they're the ones that do not prohibit it. It's actually the bylaws of S corps that prohibit IRAs from investing in them. So those are the 3 things that you are not allowed to invest in inside of a self-directed IRA. So that concludes my portion of the presentation, and now I'm going to go ahead and turn it over to Richard Thornton, who is the managing partner of American Note Capital, and he is going to provide some insight on peer-to-peer lending.
Great, thanks, Mindy. So let's talk a little bit about my background first. Oops, sorry, I developed or advanced the slide too quickly there. I'm with American Note Capital, and I've been in real estate for 30 plus years. In the mid-'80s, I started a mortgage banking firm, a commercial mortgage banking firm with another fellow, and we sold it in the early 2000s with about an $8 billion portfolio. I've invested in senior housing for a number of years, larger projects nationwide. I've also been a hard money lender at one point, and post-recession, when the market was good, I said, hey, it looked like it would be fun to flip some houses. So I did 18 of those. So I've had a varied background. We also all have to follow our paths and the opportunities. So that's what I've been doing. And for the last 4 years or so, I've been investing in mortgage notes. Regarding peer-to-peer lending, and for our discussion purposes here today, we're going to start very broad. I'm going to talk to you a little bit about how the market got started, what the different tiers inside the market are, and we'll finish up with a more specific traditional product, which is investing in mortgage notes. At the end of this presentation, on the last page, I've provided 6 to 8 websites that you can go to that'll give you a ton of information in terms of P2P markets, what they are, where to invest, who's investing how, which, and where. So there's a lot of information that you'll be able to get just off of those websites. So let's get started. If you go to Investopedia or Wikipedia, they defined P2P or peer-to-peer lending as the practice of lending money from one individual to another, sometimes part of a private company. And it's commonly referred to as P2P. It's a two-tiered market as it exists today. There's the online market and then what we'd call traditional P2P lenders. I think we all could acknowledge that we've probably all made a P2P loan. It's a fancy name for if your friend borrows some money, or your child or whoever from you, and you lend it to him. That's a personal loan, so there's no education that's needed there. But as far as the online sites, there's crowdfunding, which is equity, and then there are the lending sites. The more traditional lenders, and this is just my breakdown of the market, are hard money lenders, seller carryback lenders, pawn shops, and payday loans. We're going to talk all about those in just a little bit more in just a second here. So let's talk about the online portion first. If we look at the crowdfunding equity, and that's not really the focus of our presentation today, we're really looking at the lending side, but I did want to at least mention it. There are groups like Kickstarter, Crowdfunder, and Rocket Hub. I just picked those 3 because they're some of the leaders in the market. If you want to invest in those, you're actually getting a piece of ownership or not in the company that you invest with. I'll give you one example. Neil Young, the guitarist and singer, thought that iPods didn't have good enough quality in terms of the music that they produced. So a number of years ago, he started something called Pono. He thought he would have an upscale presentation platform for high quality music. So we went out and raised a couple $1 million from people. He didn't give them any equity in the company. They just gave him the money out of the sort of goodness of their heart. He had a second raise, and the company didn't end up going anywhere, but it was, I think, some people enjoyed sort of dealing with a celebrity and things like that. If you invest through Crowdfunder or Rocket Hub, you can get equity in whatever startup it is. And those, each of these groups that I'm mentioning have a specialty. So one might have a social benefit, one might specialize in any other given sector of the market. In terms of lending sites, the 3 I selected, just because they're all very different, are Kiva, Lending Club, and SoFi. Kiva was actually started as a social benefit lending site, making microloans throughout Africa, Bangladesh, Asia, places like that, for people who want to have startups, and those are very small loans. Lending Club was on a larger scale, more in the terms of somebody making a loan to a mom and pop here in the States or someplace like that, starting a business, and the loan sizes were larger, $10,000 and things like that. But they've actually morphed into a full-service lender where you can, while you can still get business loans from them for smaller startups, you can also get car loans and home loans and things like that. So they're not completely P2P lenders anymore. And the same was true for SoFi. They started out in student loans and have broadened their platform since then. So let's talk a little bit about microloans. I think many of you know about those. A lot of the microloans go to third world countries for people to start businesses. This has been a real game changer for a lot of people and has been very profitable. It actually started in the 70s by a gentleman who got a Pulitzer Prize, a Nobel Peace Prize for starting his efforts. And it took off when the internet came along. Hard money lenders typically make loans to flippers and people who are renovating houses. They also might be making loans to a commercial borrower for renovating a commercial building and or starting up some company. In terms of seller carryback lenders, a seller carryback loan is offered to somebody who is usually buying a residence or a building, and the seller sells the property to the person and then creates a mortgage. And we'll talk a lot more about that in just a few minutes. And then pawn shops, well, I think we all know what they are, and payday lenders. I think most people wouldn't think of those two categories as being P2P loans, but they are. If you think about it, a pawn shop is owned by some one person, and he is making a loan to somebody else based on the value of their ring or watch or whatever it is they've brought in. And the pay-to-pay lender is lending on the value of a paycheck. So they are truly P2P lenders. So let's talk about the beginning and how did all this really start on the scale of what we have today. The two big things. One was technology, and the second was the Jobs Act of 2012. Obviously, as Amazon and Facebook and everybody else who sells anything, Netflix has been able to flourish, so has the lending field and or the equity raising field. It provides, internet provides a means for raising money, contacting people, selling things that's very cheap and easy and is much faster than we previously knew. So that was the big thing. The other factor that really played into the lending side and the equity side was the Jobs Act of 2012. When Congress needed to do something to get us out of the recession, they were trying to come up with something, and so they changed what's previously known as the Regulation D laws. Reg D still exists. If you are going to raise money for a large syndication where people would usually put in, say, $100,000, $200,000 or something like that, there are a lot of restrictions pertaining to that, meaning that you can't advertise, you're limited to 35 investors, it has to be registered with the SEC, and they're relatively cumbersome to do, and that's why this market didn't take off. What the jobs market says is, okay, for investments that are smaller, you don't have to go through all that. Matter of fact, all you have to do is register somebody and get their name and address, and you can go ahead and raise money. So that was a complete game changer, because that meant that people could now advertise for loans and or equity, and they could get a lot of money from a lot of people, a little in smaller installments. Rather than putting in $100,000, somebody can put in anywhere from $5 to $5,000 and still participate in this type of lending and or equity. What has P2P lending grown to since its start? Well, the current estimates are that the volumes are exceeding $1 trillion annually, and that's worldwide. Obviously, most of it started here in the U.S., but it has grown throughout the world. Also, estimates are that $387 billion of that $1 trillion are made in consumer loans. People who want to buy cars, people who want to use credit for whatever purpose for themselves. And the annual growth rate is estimated also at being slightly over 40%. So that tells us that we're still quite a bit in the wild, wild west here. The market is growing significantly and very fast. And so one has to have a little bit of caution, I think, when investing in something like this. But that's not to say that it isn't a great place to invest your money. So what are some of the characteristics of P2P loans? Well, they tend to be faster, and you can get them easier than traditional loans. We all know that if we go to a bank and try and get a loan, or a credit union or wherever, there's a ton of paperwork to fill out, and they run our credit, and who knows what else, and there are a lot of restrictions to apply to that. And I'm not saying that you don't have to fill out paperwork to get a P2P loan, but quite often you can do that on the internet quite quickly and much easier. The loans are also made where traditional lenders won't lend. So a lot of banks have their guidelines. After all, they have depositors' money that they have to protect, and they're very heavily regulated. And there, for the most part, are no such regulations on P2P lenders. So they can make a lot of loans that ordinarily would not be made by a bank. The rates are slightly higher than what a bank would lend or a credit union would lend at, but they're certainly much lower and easier to get with than a credit card. Credit cards, as we know, are 19% plus, and if you can get say a 10% P2P loan from somebody to maybe help out your automotive supply company or something like that, that's a lot better alternative. And they also tend to be smaller size. P2P loans, I think you'd have to say that they tend to be under $50,000 and can be for as little as several $100s. Some characteristics of the P2P market are changing. As with anything, as it matures, it was in the past the market was completely unregulated, but as the volume has increased, a lot of different countries have imposed some regulations on these type of loans. Depending on where the company is based, if it's based in Europe or Asia or the US, different regulations will apply. It's still largely unregulated, but different countries are pulling some regulation into the field. And I should also say that with the advent of a lot of these websites morphing into more like brokers, where you'd be, say, brokering a home loan, those type of loans, which are traditionally and actually not P2P loans, are heavily regulated. So to that extent, regulation is creeping into the market. Loans are short-term. Well, that's, again, changing. A lot of P2P loans tended to be 6 months to 2 years. We're starting to see more loans made to small businesses and things like that are 5 years, 10 years. And if you're getting a home loan or something like that, obviously it's going to be a 30-year loan, but again, that's not a true P2P loan. And then the fact that the loans are unregulated and, most importantly, uninsured. That's still the case, but again, where these companies are offering more traditional loans, like home loans, they can be insured as opposed to uninsured. So how do you participate? What do you folks all have self-directed IRAs conceivably and want to participate in this? I'm going to sound a little bit like an investment counselor here, but I'm not offering advice. What I'm suggesting here is just good old common sense. The first thing to do is determine your goals. Do you want a high rate of return, or are you satisfied with a lower rate of return? Why would you be satisfied with a lower rate of return? Well, you might not want to take the risk that's associated with a high rate of return. You can get maybe 10% from a hard money lender, but you're taking a lot of risk by doing that, and we'll discuss that a little bit more. You can go online and do your research and find out who is making loans in a given sector, and determine what sector you want to invest in. Maybe you want to put your money towards a group that has a good social purpose, or maybe you want to be primarily in tech, or maybe in food products, or whatever it is. You just have to do your research. You can find a lot of that online, and the websites and URLs that I've provided at the end of this presentation will answer a lot of those questions for you. So just do your research. You also have to have some caution and watch out for scams. There used to be more scams out there than there were, but just because a company sounds, based on its name, like it's a good old USA company, it might not be. And it might be based in Africa or Asia or some other place that's completely unregulated. And some of these companies are nothing more than Ponzi schemes. So you do have to be careful as to where you're going to put your money. But once you've done all that, if you have decided that what your criteria is and everything else, basically talk to your lender that you want to invest with and find out what their criteria is. They all have a very determined set of criteria and information that you need to provide them. Most of this can be done online, and it's pretty simple to do. And once you've done that, talk to the folks at Intrust. They have a very good and qualified staff in helping you make these investments. They're not offering you any advice, but I've funded quite a few of my investments through them, as have my clients, and they've always been very proficient in terms of helping us out and getting the investment made. So that's the online side of it. Let's talk a little bit more about just traditional P2P loans. I think the one that comes to mind most often is hard money. Obviously, we can't participate in payday loans or pawn shops, but in a hard money loan, you've got hard money and private mortgage notes. Some of the characteristics of hard money loans are that they tend to be shorter term, anywhere from 4 months to 2 years. Most commonly made these days to flippers and renovators of homes, but quite often you'll see somebody who is starting a company or has an ongoing company. I had a request the other day for a fellow who wanted a hard money loan that has been a printer in the Sacramento area for almost 20 years. He wanted to buy a printing press and couldn't get a bank loan for various reasons. And so he was requesting an amount of money to buy that press. So it really just depends, and that was going to be a five-year mortgage. What you do need to know, though, regarding hard money loans is they're usually much higher risk. If you think about it, with somebody who's buying and renovating a house, and I know that a lot of us, myself included, have done quite well with hard money loans, and I'm not trying to discourage anybody from making them. I'm just saying be aware when you do that they are higher risk, because you're usually buying a house, let's say for $200,000 or less, and providing amount of money to it towards the renovation, whereas if the developer or the flipper went under for whatever reason, could not finish the renovation as designed, you'd be up a creek, because the collateral value wouldn't be there. If the project was partially done, it couldn't be sold for the amount of investment that was in it up to that point. So it's, buyer beware. There is construction risk. Sometimes you get into a project. I had a project that I got into, and there was over $50,000 worth of dry rot damage that I couldn't see from the outside. So I had to absorb that in one of the flips that I did. Material costs rise, and construction cost in general. Due to the wildfires that we've had here in California, I've had several construction people tell me that costs have gone up almost 60% over the last 2 years. So if somebody had been starting a project just at the tail end of last summer, they may have had a very rude awakening when they tried to get their bids for their construction. And then there are sometimes delays. Those could be caused by the cities and or maybe materials. And just the market in general, which we all know about. We're getting a little bit late in the game, I think you'd say, regarding the this cycle of the economy. And some people are expecting things to slow down here. So if you do want to participate in a hard money loan, keep that in mind, that there is some risk, because we are seeing some softness in some markets where people can't sell houses for what they thought they were going to be able to sell them for. So how do you make an investment? Again, you have to do your, determine your goals of how much risk you are willing to take. You can go on the web and find a number of different hard money lenders. If anybody would like to know about a California-based hard money lender or national, and they want to call me after this presentation at some time, I'll be glad to give them some names of groups that I know are very reputable. But there are a lot of local people who are doing this. You can talk to your friends. You can look at local advertisements and get a lot of information. And again, if you're dealing with a smaller person, watch out for scams because they are out there. So the other category in traditional loans is private mortgage notes. And that's my area of expertise. My company focuses on properties that are primarily in the Midwest. I'm living here in the San Francisco Bay Area, and if I was going to buy a nice 2-bedroom, 1-bath, or 3-bedroom, 2-bath house, I would have to pay probably somewhere in the vicinity of $700,000 to $1 million for that house. I can buy that very same house outside of Indianapolis or Akron, Ohio, or even St. Louis for literally a tenth of what I could buy it here. Now you might question my sanity as to why I would choose to live in the San Francisco Bay Area and pay that much for housing. But that's another matter. But these properties are out there and they're very nice. Little tree-lined streets, and a lot of people have a problem getting them financed. And the reason for that is that the loans are small. If you have a $60,000 mortgage and the buyer puts $10,000 down, it's only a $50,000 mortgage. And there are federal regulations that limit the amount of fees that lenders can charge. And a lot of banks just say, I'm sorry, it's just not worth our time to make a $50,000 mortgage. We can't make as much up front, and the servicing income isn't great, so we'd rather not do it. So John and Mary, borrower, whoever they are, could have a perfectly good credit and not be able to get a loan. Plus, there's a lot of people out there who are legally in the U.S., but they're not citizens. Maybe they're Canadians or something like that, and they can't get a loan. So there are a lot of reasons that a seller would carry back a loan, and if they sell a house, say, look, the house is for sale for $60,000, you put $10,000 down, and I will create a mortgage for you. So we buy those mortgages from those people. We usually wait until they are seasoned, meaning that they're at least 2 or 3 years old. So we have an idea that the borrower is going to have a good payment history. And there's other underwriting criteria that I'll talk about in just a minute. But people decide to sell these for whatever reason. They may say, well, gee, I found some investment I want to make, so I no longer want to accept that or take that cash flow, or any number of reasons. And a lot of people like to buy these mortgages because they want to participate in real estate, but they don't want to have to muck around with the day-to-day. They don't want to have to take care of tenants and rents and things like that. And they want to avoid what are commonly called the 3 Ts, which are tenants, toilets, and turnover. And that's the day-to-day stuff that you have to deal with if you are a rentor. So what are the characteristics of private mortgage notes? Well, as you would expect, they tend to be longer term. Most of these mortgages are 20 or 30-year mortgages. And if I buy one, say that's seasoned, maybe it's 3 years old, there's going to be a 27-year term left. Someone as yourself might say, well, gee, I don't want to buy a 27-year investment. I'd really like something shorter. If you do that, you can actually buy a partial, which is just the front end. I don't mean you're buying just a portion of a note. Let's say if you had a $100,000 mortgage, sometimes somebody will talk to you and say, look, why don't you take 20 and Joe will take 20 and somebody else, another investor will take 30 until you get up to 100. It's not a participation. It's what's known as a partial, where you can buy the first, say, 10 or 12 years of the income stream that's produced by that mortgage. So you'll get the payments, $500 a month or whatever they are, and you will wholly own the mortgage for that period. A lot of people like this type of investment because they're conservative. They're safer than the stock market. When we look at a mortgage note, we're only looking at what's known as a first trust, which means you have the right to get paid first ahead of anybody else except for Uncle Sam if there's taxes due or anything like that. Some people will say, well, gee, you can buy a second and get a much higher return. And that's true. You can do that, but you're second in priority. That's not something we look at. We look at something that's longer term, something that's great for retirement. These are good investments for self-directed IRA investors because they can get their return on a tax-free basis. And depending on whether they have a Roth or a regular IRA, they may or may not have to pay taxes on it when they finally take the money out of their IRA account. So they like that. Also, the loans are backed, or the notes are backed by the value of the real estate. When I say they're conservative, I mean that if you have a $60,000 house and your investment is, say, $30,000, which would be the mortgage amount or a portion of the mortgage amount, you're only at 50% loan to value. So as an investor, you have to say, well, what if the borrower defaulted? Because that's always the $60,000 question. And if they did, you would have to work with local counsel and take the property back. But there's a very high chance that you could sell that property for $30,000. That's all your investment is. If it was a $60,000 house, even in a slow market, you could mark it down to, say, $40,000, and I'm sure sell it quite quickly and get all your money back. And you can't, that can't be said for you when you are investing in the stock market. So you've got a conservative property that's backed by the value of the real estate. And also, your borrower has equity in the property. So let's think about yourself. If you own a house, if they've put $10,000, $20,000, $30,000, whatever it is, into it, they don't want to lose that property. So they'll do everything they can to keep your investment solid. How do you invest in these? Once again, you determine what your goals are. You determine what your comfort level is with the risk. Maybe you want to make shorter term loans. Maybe you are comfortable with a higher risk. You can do your research on Google, or you can ask a lot of friends. Again, I've got the URLs at the end of my presentation here. Has a lot of different information on where you can get these loans. And you can also go to my website and read an article which is called You Can Invest in Notes, which is a piece that I wrote for the investors of Intrust. And it just gives you a little bit of basic information on what it's like to make one of these investments. Find a good broker and or investor to help you out, and you can make the investments. I would suggest that you work with somebody who is an investor as opposed to just a straight broker, because if they're an investor, they usually have some interest in the note. For instance, if you bought a partial from my company, I don't get paid until the end of the period. So if it's a 10-year deal and there's a 27-year note, I don't make anything on the investment until after your 10-year investment period is up. So a lot of people like that. They say, well, gee, if this company is willing to make that kind of investment, it gives me some assurance that my loan is going to be, my purchase is going to be good, because you're not getting paid until the tail end. Whoops, sorry, advanced a little bit too fast there. So that's it in a nutshell. As we sort of discussed here, I think you can see that the P2P lending market is very robust, being over $1 trillion a year. It can be a very good investment, but it's changing fast. It's still a little bit of the wild, wild west, and so you need to be careful. I think it's fairly easy, though, to invest in this market. And if you do your homework and talk to various responsible parties. So do be cautious, but most of all, have fun. So I'm going to turn this back over to Mindy for questions. As I mentioned here, you can see a lot of the different websites and URLs that provide you a lot of information. I know that Intrust is going to post this, so you'll be able to have access to it later. And feel free to give me a call. I'm Richard Thornton. You can see my number there on the bottom, 510-918-9001, and I'll be glad to talk to you anytime. So pass it back to Mindy.
All right. Thank you very much, Richard, for providing us some very insightful education on the peer-to-peer lending. So now the question is, how do you get started with Intrust in opening up a self-directed IRA if you decide that self-direction is the route for you to go? It's basically 3 easy steps. Step 1 is to open up an Intrust account. And you can either do that online, or we have a paper application that you can submit to us as well. Both very easy processes. Step 2 would be to fund your account, and that is either from an existing IRA, an old 401k, 403b, 457, or even from a contribution. We actually have traditional Roth, SEPs, Simples, ESAs, HSAs, and solo 401ks available for self-direction. And then step 3 would be to purchase your asset. There's some paperwork involved with that, but a pretty easy process. So 3 steps to opening up a self-directed IRA. All right, now it's time for questions. As I mentioned earlier, any questions that you have, go ahead and type in the lower left chat box on your computer screen, and we will go ahead and answer those as we receive them. I'm going to go ahead and read them off, and then depending on who they apply to, either I will answer or I will have Richard answer. So first question, where can I find loans with recourse, real estate to buy? Richard, I think that would be a question for you, since we do not provide any sort of investment advice or recommend or endorse.
Yeah, I'm sorry, I didn't catch the first part of the question, Mindy.
Where can I find loans with recourse, and then in parentheses, real estate to buy?
Well, it's a little bit difficult to answer that question. It depends totally on what markets you're in. If you're in Nashville or Cincinnati or San Francisco, if you want real estate to buy, I would talk to one of your local realtors. A lot of them have very good investment properties they can buy. If you want to, I'm sorry, what was the second part of the question?
They're looking for recourse loans to buy in the real estate industry.
Okay, so, well, if you want to buy loans that have recourse, hard money loans have recourse, and you can go through a number of the reputable people that you can find online, different companies that offer hard money loans and participate in those.
All right, great. Thanks, Richard. Second question. I want to loan money to individuals who are expecting future settlement. They would be secured by the settlement proceeds. Generally, the loans are less than $10,000 and are short term. Is this possible, and are there any limitations on fees and/or interest charged? So there's three things that you can't invest in, which I went over earlier: life insurance, collectibles, and S corporations. So as long as what you're looking to invest in does not fall within life insurance, collectibles, and S corporations, yes, absolutely, you can invest in it. Now, in regards to, are there any limitations on fees and/or interest charges? I'm not sure what you mean by that, so you can send me a note offline and we can discuss, are you meaning fees on our side, or I'm not sure exactly what you're meaning on that. So just shoot me a note offline and we can discuss that further. Next question. I have a listing for 1.6. Can you buy it and sell the note to an investor? Richard, I think that's a question for you.
Yeah, can you, I sort of understand the question. Can you buy it and sell it? Yeah, yes, if they want to buy a property and generate a note to sell to an investor, they can do that. And a lot of people do that. It's a good alternative. It's a good way to get passive income and or tax-free income through using a self-directed IRA for doing that, as opposed to just selling it directly and taking a quick profit. So yes, you can definitely do that.
All right, next question. Have you had to foreclose on many P2P loans?
Well, right. I never had to foreclose on any of my hard money loans. I've actually have had to foreclose on 2 of the notes loans that I have, or investments that I've made. In both cases, they were resolved pretty easily, along the lines of what I discussed earlier. One client or borrower actually gave us what's called a deed in lieu. So rather than go through any sort of foreclosure process or anything like that, they just said, hey, look, we'll just sign the deed over to you, and thanks very much, we'll see you later. The other one I actually did have to foreclose. Took about 6 months, and I've got a whole network of local legal counsels and people to deal with, and we sold the property at a profit. So it was fine. It doesn't always work out that way, but the 2 that I've had have worked out just fine.
Okay, great. All right, next question. Is KYC, know your customer, one of the regulations for any of these opportunities? If so, who takes on this responsibility? Thinking specifically about the foreign mortgage borrower banks won't touch. So in regards to KYC, we perform that on our clients. We do not do any due diligence on what our clients are investing in. It is completely self-directed. We do not hold any fiduciary responsibility. So it's up to you to do your due diligence and know what you're investing in. All right, next question. What is the range of net annualized interest rate to investor for mortgage notes?
Well,
Richard,
it
I think that's a question for you.
Yeah, it depends on what you're investing in. I think some people, well, for the typical sort of note that I'm talking about here today, where you get consistent, stable returns, it's primarily a passive income, you're usually talking about 6 to 8%. Now that's obviously not taxable, so you have to compare that to either a 9 or 11% pre-tax investment if you were doing this on a taxable basis. If you're investing in second trust, some people will say, well, gee, you'll get 20%. And there's a whole realm of what's called non-performing notes that we haven't discussed at all, which you actually have to participate in. I really didn't think that that was too applicable to this audience because, well, I don't know what the real estate experience that anybody has here is, but if anybody wants more information on that, I'll be glad to talk to them later. Just give me a call or send me an email. But typically I'm talking for the investments that I have year in, year out, consistently 6 to 8% tax-free.
Okay, great. Next question. Does Intrust already have a relationship for investments to American Note Capital? The answer is yes. Richard mentioned that earlier in his presentation that we do have mutual clients. Next question. I want to make a P2P loan to a small business startup company. My son is one of 3 partners. I know you cannot make a traditional IRA P2P loan due to conflict of interest in negotiating the interest rate terms, etc. However, can I make the P2P loan from my self-directed Roth IRA since the profits from the interest is exempt from taxes? The answer to that is no. You cannot lend money to any disqualified person. I know we didn't fully go over what a disqualified person was, but a disqualified person would be yourself, your spouse, your lineal ascendants, descendants, their spouses, meaning children, grandchildren, great-grandchildren, all of their spouses, your parents, your grandparents, your great-grandparents, all of their spouses, financial advisors, managers, beneficiaries, or entities where any of those disqualified persons have ownership. So you cannot do that within any retirement account that is self-directed. Next question. Can you give a personal loan within a self-directed IRA or checkbook IRA? And the answer to that is you can lend money to anyone as long as they are not a disqualified person. So again, the individuals that I listed earlier, those are disqualified. You cannot loan money to them, but anyone else, perfectly fine. All right, next question. I have a Roth IRA. My wife and I have $15,000 solar loan from a bank at 5% interest for 15 years. Can I loan money from my Roth to myself or my wife to pay off the loan? The answer is no. You cannot lend money to any disqualified person. Again, a disqualified person is yourself, your spouse, your lineal ascendants, descendants, their spouses, financial advisors, managers, beneficiaries, all disqualified.
You said that before.
All right, next question. Yep. Does American Note Capital provide diversified portfolio options, or are we picking individual mortgages and then on what basis?
Well, so diversity is offered through the locations of the loans. So if somebody said, they came to me and said, gee, I have $100,000 and I'd like to buy, let's just say 4 $25,000 loans, we could buy them all in one area, or I could buy one in, say, St. Louis and another one in Indiana and another one, places like that. So you get your diversity that way. When you buy a note of this size, you're not buying just a portion of it, you're buying the entire loan, which actually I think is better. A lot of people don't like to deal in partial ownerships Sometimes if I'm dealing with a note in California and it's an $800,000 note, I have to have 4 owners of that note, and they don't know each other, and they have to make decisions together and things like that, and it can be a little bit cumbersome. The investor does not have to underwrite the borrower or anything at all. That's part of what I do, and that's my responsibility. So basically, I present them with any number of opportunities. I've had some people say to me, investors say, gee, I really like Wisconsin, or I really like St. Louis. And so we'll look in that area and invest accordingly.
Okay, great. Thanks, Richard. All right, next question. I have an account already. As I will be making small short-term loans, should I fund into a loan company LLC, then make the loans from there? We cannot advise you on how you should structure it, but if you want to talk about your options, and we can discuss fees offline to determine which makes sense from a financial standpoint, we can do that. Next question. How can I do a loan for a mortgage for a relative? All right, so already discussed, it can't be a disqualified person, so you cannot lend money to yourself, your spouse, your lineal ascendants, descendants, their spouses, financial advisors, managers, beneficiaries. However, siblings, aunts, uncles, nieces, nephews, those are all considered qualified persons that you can loan money to, so just keep that in mind. Next question, is loan income subject to UBTI? That's a question for a tax advisor. We do not answer tax questions. Can we fund the account with a trust fund? That's something that we'll want to talk about offline because it's going to depend on how it's structured. Next question. Is the income that is generated from the investment taxed as ordinary income, or is it retained in the IRA? So the whole idea behind self-directed IRAs, whatever you're investing in, all of the earnings go right back into the retirement account. However, it's a tax question. Depending on how it's structured and what your tax situation is, that's something that you would want to consult with your CPA or tax advisor. We're not licensed to answer tax questions. What is the cost to open an account with Intrust, and what are the fees for custodian? So $50 to open the account, and then we have 2 different fee structures. The first fee structure that you can select from is $2.99 a year per asset. The second fee structure is a tiered percentage scale multiplied by the value of the asset. It ranges anywhere from $199 all the way up. There are some other transactional fees. We do have a fee schedule that you can access online at our website, or if you shoot me an email, I can also email you over our fee schedule so you can see all of the other smaller transactional fees. Next question, does American Note provide underwriting?
Yes, we don't. That is our responsibility, and obviously, especially if we're selling a partial on these, we would completely underwrite the note in terms of its location. We didn't really go into the characteristics of underwriting here at all, but I've got a whole presentation that I do on that in terms of underwriting the borrowers, seeing what credit worthiness they have, payment history, and everything of that sort. So the answer is yes.
All right. What is the range of net annualized income rate to investor on hard money loans?
It depends completely on the typical loan. A lot of lenders pay anywhere from 9 to 12% on a hard money loan. Now, you actually asked the question very astutely, in that quite often hard money loans are 6 months, 8 months, or something like that. So let's take the example of a hard money lender that pays, say, 12% for 8 months, but then you don't have any other investment for the remaining 4 months because he doesn't have another house to flip or something like that. Well, what you have to do is annualize that rate, and if you do that, you're going to find out that you'll be down around 10% or 8%. I don't have the numbers on the top of my head, but so you would compare that to something where you'd be longer term, and you'd have to say, well, am I better off getting 8% longer term with less risk, or putting my money out at 10%, but it's only out for 8 months of the year? That's you always have to have apples to apples to make that analysis.
All right. Do you advise a separate account with Intrust for each mortgage bought? We can't advise you on how to structure your investments, but we can discuss what fee schedules would look like for having multiple accounts versus having one consolidated account. So that's a conversation that we can talk about offline. Can you explain the backdoor Roth? Oh, go ahead.
Mindy, I can make one comment on that if you want me to, in terms of what I know that I and my other investors have done, which is you have one or maybe multiple accounts with Intrust. Let's say you just have one, and as with any other investment, you invest. Let's say you have $100,000 and you're buying a $25,000 note. You sign what's called a buy direct letter, and you give those instructions to Intrust, and they make the investment for you. It just comes right out of your account, just like any other investment. You don't have to set up a separate account for each one.
Yep, absolutely. So the other thing that I want to add to that, though, that I was mentioning earlier, depending on, since we do have two different fee structures, you have one that's a per asset and one that's a by value. Depending on how many loans you have and what the value of those are, it might make more sense to have multiple accounts from a fee standpoint, or it might make more sense to just have them all consolidated into one. So that's just what I was meaning by your options and determining which one's going to make more sense from a fee standpoint. Next question. Can you explain the backdoor Roth IRA for folks whose income exceeds the limit to contribute to Roth IRAs? So backdoor Roth simply means that you're doing a conversion. You're contributing to, let's say, a traditional or a SEP or whatever type of plan you're contributing to. Backdoor Roth is you're doing a conversion. Definitely something that you want to talk to your CPA or tax advisor on to determine if that's something that you should do in that tax year. We don't really go into that because that's more of a tax question for your accountant or CPA. What is an approximate rate of return that can be expected from notes investors participate in?
Well, I think we already answered that earlier. If you want to invest in a second trust or something like that, you can probably be north of 15%, but that's a huge amount of risk in that. What I usually invest in is usually 6%, 8% annualized for like 10 or 12 years, whatever period they'd like to buy.
Okay. I currently have a simple IRA with Intrust, which I have been investing into realty shares investments. My question is, can I invest some of the IRA funds in other investments? If so, how do I go about setting that up? The answer is yes. You have complete control over what you're investing in. There is some paperwork that's involved in that. Contact your local business development manager, and they will provide you with the paperwork needed to invest in the additional investments. Next question, can you explain wholesale real estate?
Yeah, I can explain wholesale real estate. So typically what happens when real estate is wholesaled, and you have a wholesaler, you have a number of people who do nothing but contact different realtors, anybody with a scour tax records, any number of sources, and they find property that they think is undervalued. And they will agree to, they negotiate to buy that property, and then usually go to a local meetup or real estate investment meeting of some sort and sell it to an investor that wants to flip the property or something like that. So they're basically being a broker. What they're really good at is finding properties that are undervalued, that they see value in, and so they take whatever their fee is and sell that to somebody who wants to flip it or be an investor or something like that. That's what a wholesaler is.
Okay, great, thanks. Next question, does Richard buy mortgage notes?
Yes, that's exactly what I do. I buy them from exchanges. I buy them from individuals. I also create them. I had one property, somebody asked about buying a property. I had one property that I was able to buy very inexpensively, put just a little bit of money into it, and I sold it at a profit, took some equity, and then carried back a note and made a nice little 10-year note that was a great little investment out of that.
All right, next question. Does Intrust have set up direct access for securities investments with any brokerage company for the investment of cash just sitting idle in the Intrust account? It's in the works. Talk to your local business development manager to determine what the steps are for that and how to move forward. Next question, what are your criteria for hard money loans? What is a reasonable for fees and interest rates for hard money loans?
Okay. Again, we answered that, I think, a little bit earlier, which is most hard money lenders pay 10 to 12% to their investors. Typically what they'll do is they'll pay whatever the rate is that they're charging the borrower, and they'll take the fees themselves. So let's say it's a loan that's got a 12% rate on it and a 4% fee. They'll pay the 12% rate to the investor, which would be the Intrust investor, and they'll keep the 4% fee for themselves.
All right. Next question. What are the dynamics and or pitfalls of buying a piece of land through my IRA with Intrust, holding it, and later building on it? So
do you want to answer that, or you want me to?
Well, I'll answer, and then if you have anything to add, feel free to. So a couple of things. If you're going to buy a piece of real estate, a piece of land through your IRA, and then later build on it, you can't personally contribute that money for the build. You either have to buy the land and the later build with IRA money, or you have to partner with somebody who is a non-disqualified person to build on that, because you are not allowed to partner with yourself or a disqualified person after the initiation of the purchase. So I guess you could see that as a pitfall, meaning that you can't buy it and then later build on it with personal money. You could do an in-kind distribution once you're of retirement age and then have that property retitled in your name and then build on it personally. That would be an option. Obviously then at that point you would be responsible for all the taxes on that property. Richard, and then if you have anything else to add.
No, I think that's, I was just going to say pitfalls can be the fact that your property value can drop and things of that sort, but you did a great job.
Okay, great. I want to use my self-directed IRA to make a down payment on a property through my LLC. The person I talked to said I shouldn't have a third party. The IRA should be the only owner. So when you're buying real estate, you have options if you don't have enough money to fund the entire purchase. You can leverage, so that is an option. However, it has to be a non-recourse loan. You can't go to a financial institution and assign as a personal guarantor on the loan, nor can anyone. It has to be a non-recourse loan. So you can leverage. You also have the ability to partner. You can partner with somebody to purchase that property as well if you don't have enough money to cover the entire value of the property. All right, next question. I have a relative who is looking for a loan for his business. Can I loan him money from my IRA with a simple MOU outlining the terms of this loan? So as long as he is not a disqualified person, you are allowed to loan money. A disqualified person, again, yourself, your spouse, your lineal ascendants, descendants, their spouses. So parents, grandparents, great-grandparents, their spouses, children, grandchildren, great-grandchildren, their spouses. Not allowed. Financial advisors, managers, beneficiaries. None of those individuals you are allowed to loan money to. Next question. If I invest in an LLC that was a startup and it is sold and was financed, can the payments be made back? Can the payments be made back to my IRA from the purchaser? If I invested in an LLC that was a startup and it's sold and was financed, yeah, so any of the earnings or the payments have to go back into your IRA, otherwise it's counted as a distribution. Next question. Will this be allowed in the new Trump Opportunity Zone Growth Fund? So I'm not extra familiar with opportunity zones, but as from what I understand, opportunity zones benefit individuals who have capital gains tax. So it's a similar concept. You're investing in a piece of real estate. The earnings are going back into your retirement account and should be growing tax-free or tax-deferred, depending on your tax situation. Obviously, you want to consult with a tax advisor or your CPA. And Richard, is there anything you want to add to that? Because I'm not extra familiar with opportunity zone.
No, neither am I, so I'm going to be quiet.
Okay. Next question. I invested in mortgages, but only was in the second and third position and had to pay off first. Be careful, I got burned. Okay. Guess that's not a question, that's a comment. If I want to borrow money from a friend, they would have to put money in a self-directed IRA before they can loan it to me. I'm not sure if that's a question or not, but if you want to borrow money from a friend, they can loan you money. They can loan you money inside a self-directed IRA as long as you're not a beneficiary to them or a financial advisor or manager. As long as you're not a disqualified person, anyone can loan money in an IRA to an individual that is non-disqualified. Can you buy educational loans? Again, that goes back to there's three things that you cannot invest in inside a self-directed IRA: life insurance, collectibles, and S corporations. All other investments are allowed. Next question. You mentioned disqualified persons. My understanding is if lending to a company, as long as the ownership is less than 50% of that loan would be allowed. Correct. That is incorrect. When you're loaning money, you cannot have any personal ownership, nor can a disqualified person. Strictly prohibited. You can invest in companies where you or a disqualified person have less than 50% ownership, but lending money, the IRS does not allow any percentage of ownership from your disqualified person. All right, next question. Could I purchase properties or mortgage notes abroad? So again, three things that you can't invest in: life insurance, collectibles, S corporations. Now, if you're talking about purchasing properties overseas, a lot of times you're going to want to check, or actually all the time, you're going to want to check with that country to see what their requirements are. Most overseas countries, they don't allow IRAs to purchase property. You have to form some sort of entity in whatever country that is, and then the IRA being a member of that entity, and then that entity purchasing the property. You'll want to check with that country's regulations on real estate purchases. Can you lend money to a trust? So Fact 2, as long as it's not a disqualified person, you can lend money to anyone. P2P companies like Lending Club and Prosper have been struggling to be profitable. Is this crowdfunding model viable long term?
You know, depends on your point of view. I don't want to dodge the question, but you know, Uber is not profitable yet, and I don't think Facebook was profitable when it went public. You know, it's pretty common for these companies to go public and then become profitable later on. So I don't know really how to answer that question other than it's anybody's guess.
All right, great, thanks. Next question. Does American Note Capital only handle loans within IRAs, or do you handle investments outside of the IRA 401ks?
Either way, some of my investors just make what I call a regular cash investment, and some other people prefer to do it through a self-directed. They'd rather get the benefit tax-free as opposed to taxable. But either way, I've got I have a number of investors who use all sorts of formats. Some people do it through LLCs. Some people do it privately through their own accounts. It's a real mix.
All right. Next question. When you say a beneficiary is a disqualified person, beneficiary of what? The IRA. Yes, that is correct. Beneficiary of your IRA. All right. Last question. Again, if anyone has questions, please type them in the lower left corner comment box. Can you do a partial distribution of monies in our Intrust account? Yes, you are allowed to do partial distributions. Obviously, if you're not of retirement age, then there's a tax penalty involved, but partial distributions are allowed. Partial in-kind distributions are allowed. You'll want to talk to your tax advisor or CPA before doing such if you're not in a position to do that. All right, it looks like there's no other questions. We'll go ahead and give it another 30 seconds or so for anyone to type up a question. Just as a reminder, this will be posted on our website and our LinkedIn page so that you have all of our contact information, so that you have a copy of the presentation and the links that Richard mentioned earlier in the presentation. All right, looks like there's one additional question. If I buy a commercial building and fund the down payment, can my company that I do not own lease it back? I'm kind of unclear on your company that you do not own, meaning you have no ownership in the company. If you buy a commercial building and fund the down payment, number one, remember the rest of, when you're leveraging, it has to be non-recourse. And it looks like you are an employee. So there's, as long as you're less than 50% owner, and then there's also some other various subcategories under that, meaning as long as you're not a highly compensated employee, as long as you're not an officer or director. There's actually about 5 or 6 different subcategories under that, so as long as you don't fall within any of those subcategories, it could be possible. It's something that you would want to talk offline about and probably seek legal advice on. All right, one more question. Does Intrust have set up direct access for securities investments with any brokerage company? That was a repeat question. All right. It looks like, oh, there's one more. Can I use the IRA to purchase property for a flip and have the IRA as a mortgager, but keep the but my LLC keeps the capital gains and the IRA would get interest on the loans? So any purchase that you make inside of your IRA, all expenses must be paid from that IRA. All income that that property is earning must go back into the IRA. It all stays within that account. Are there any extra tax forms to file when loans are made within IRAs? That's a question for your CPA or tax advisor. All right, it doesn't look like there's any other questions coming through. We'll go ahead and wrap it up. Richard, was there anything else that you wanted to mention?
No, not that I can think of other than if you have any questions, go to my website, AmericanCapitalNoteCapital.com, or don't hesitate to give me a call, 510-918-9001, and my email address is there on the screen. I'll be happy to, even if you don't want to invest in notes or you have any questions about the person who said they lost a lot of money or something like that, I'd be glad to sort of give them a little bit of coaching. I'm just here to help people, and I appreciate the opportunity.
Great. All right, well, thank you everyone for joining us today for the webinar. And if you have any questions, feel free to reach out to either Richard or myself. And like I said, the presentation will be posted for replay on both LinkedIn and our website. Thank you, everyone.